Well, the 3-month consumer sentiment index is up almost 25%. And that is a much more reliable trend than this wiggle we got off of the movement from the preliminary, which was positive, to the final, which was negative. Look, your point about the gas price is a good one, and we're going to have to keep watching this very carefully. But I don't think anyone should change their view that consumer sentiment, consumer confidence has been moving in a pretty reliable way in a direction suggesting that economic improvements have been reaching people in a way that they weren't a few months ago. And those improvements, of course, reflect easing inflationary pressures, a strong job market, rising real wage growth, very strong consumer spending and GDP. So any 1 month can wiggle and bounce one way or another, but the trend remains solid in that regard.
We're hearing talk, Mr. Chairman. It's good to see you. Welcome back of a world in which there are no rate cuts in this calendar year. You know I wouldn't ask you about Fed policy, but I just wonder what that says about the strength of this economy and whether it's a runaway train.
Well, I guess you have a lot of things going in different directions here. I mean, we had some inflation reports that came in above expectations, and then we had an inflation report that hit expectations dead on. We had a retail sales report that, if anything, went the other way, more cool than hot. We have job numbers that have been exceptionally strong. I think you really have to, again, I think it's really important to look at the underlying trend. One of the most important is the unemployment rate that's been below 4% for 2 years running. That's a great number. It's supporting, as I mentioned earlier, nominal wage gains that are beating inflation. So real wages up about 10 months in a row. Again, a pretty reliable trend there. So one of my jobs is to, of course, look at carefully and get all kinds of nervous about the high frequency data flow, but to really keep an eye on the underlying momentum, which remains strong.
Well, you say the underlying momentum remains strong. You point to the strength of the labor market specifically. When you look at this economy, Mr. Chairman, do you see any sign of easing being necessary?
Well, I'm not going to get into what the Federal Reserve should do with monetary policy. What I will say is I just was looking at some of the forecasts for Q1 GDP, and I've seen numbers that are in the 2% range. Let's call that something like trend growth. Now look, the way these hydraulics work, as you two well know, is that if the economy is growing at trend, the unemployment rate tends to stay around where it is. And again, my very broad theory of the case is that as the labor market remains strong and inflation continues to ease, again, on trend, continues to ease. And that too, by the way, is a very reliable forecast. Virtually every forecast I've seen has inflation continuing to ease throughout the year. That's a recipe for rising real wages. Now, in an economy that's 70% consumer spending, that's a good recipe for continued growth. I'm not going to say anything about what the Fed should do there, but that is and has been a reliable recipe to keep things moving forward in a good way for American households.
Jared, I'm sure you're looking forward to the State of the Union address. This is a big week ahead for the White House. I don't know to what extent you're involved in contributing to the framing of the economic argument that the president is going to make next week. But we're reporting that he's going to call for some familiar ideas, higher taxes on the wealthy and businesses. There are some other things that we can talk about outside of the economy, but I wonder what it is that you're looking forward to message to the American people next week.
One of the reasons I get to come out here and talk to you is because I don't get ahead of the president. I'm certainly not going to do that when it comes to the State of the Union. But what I can tell you is the last part of your question is very much on point, which is the message to the American people, not referring anything to SOTU, as we call it around here, State of the Union, but just the ongoing economic recovery. And I guess I do think that this narrative tends to get lost in the hurly-burly of the everyday news flow, which I understand. I'm part of it. So are you. Sure. And we get it. But let's pull back a second and think about where we were and where we are. Okay, when we got here, the vaccination rate was about zero. We had a great vaccine, but it wasn't getting out there. We had families and businesses looking really worried about getting to the other side of the pandemic. The president gets here, puts the rescue plan in place, gets checks in pockets, shots in arms, massive improvement in the vax rate, and here we are now, all these years later, in the midst of a remarkable recovery, particularly in the sense that people said we couldn't do it. I mean, economists, Tony economists, said we couldn't get the inflation rate down by 2/3 without giving up a bunch of points on unemployment or on GDP. Well, I just told you we had a GDP north of 3% in Q4, tracking 2% in Q1, unemployment we've talked about, and all of this with inflation down 2/3 off of its peak. So I would consider this pretty remarkable recovery. Now, for President Biden, it only matters if it's reaching families at their kitchen tables, full stop. If I go in and tell him, I go in the Oval and tell him about GDP and the stock market, he's going to want to know from me, how is that helping families like the one I grew up in, Jared? And I will explain to him that we've got real wages growing for middle wage workers, growing for low wage workers. And in fact, they're growing faster at the middle and the bottom than the high end. So the economy is delivering the goods to a lot of working families as prices ease. Now, we've got more work to do, particularly on that price side. But moving in the right direction, and sentiment indices starting to reflect that.
Well, so on the price side, given everything that you just told us about how wages have increased, the consumption engine is still very much chugging along, GDP growth stronger than expected. All of that indicates that the demand is not going down in the way that perhaps was intended originally. And I just wonder, how great of a risk do you think there is of a reacceleration in price pressures because demand has been so strong? Can you rule out that we will see another upswing in inflation?
Well, I think one of the things that we often do, and again, it's understandable, especially with the high frequency reporting and scrutinizing every data report, is that we're looking at all these bank shots. If A happens, what will B and C mean for inflation? Sorry, we've got some noise in the background.
Business goes on at the White House. We understand, sir.
we love to see working people at work around here.
That's right. It's a tight lawn game.
What I think we have to keep in mind is that the best indicator of inflation is inflation. All right? There are a lot of bank shots and a lot of ways demand can play through this. But our own analysis at the CEA has been quite clear, and I think this is largely confirmed by many other economists who've looked carefully at this, is that the disinflation we've achieved thus far has largely come from improvements on the economy's supply side. In fact, that's almost axiomatic when you think of inflation easing 2/3 off of its peak without giving much on the demand side. It kind of almost has to be supply side contributions. And our own work explains about 80% of the disinflation through supply chain unsnarling, through improvements in the labor force in terms of labor supply. We think there's still more room to run there. So it's not enough to just look at the demand side of the equation. You have to look at the supply side as well, and you have to look end of the day, beginning of the day, middle of the day. Look at the inflation indicators, which again have been easing solidly with a bump here or there in any given month.
I had an interesting encounter with Tom Suozzi earlier this week. Mr. Chairman, the newest Democrat in the House of Representatives. He was sworn in Wednesday evening. This, of course, is George Santos's former seat, and he was asked by many of the folks who were there about how did he win, and he was talking mainly about the economy, a little bit about the border as well, but he seemed to have a sense of what drives the angst, the frustration, in many cases the anger behind the MAGA movement, Donald Trump supporters, and many Republican voters around the country. And he pointed to wages as the first thing. You make $7, $10 minimum wage, even $15 an hour. That means you're not pulling in more than 20 or 30 grand a year. You can hardly afford to live. It's impossible to guarantee you can send your kids to college, secure your family. And he said that is the root of all of this. What's the message to those voters who are looking to Donald Trump for relief?
I think you really have to ask yourself, who's fighting for whom? I think we saw this contrast at the border yesterday. This president is consistently fighting to solve the challenges that we face right now. I think his track record in challenge solving on the economy is extremely strong. That's what we've been talking about for the last few minutes here. But I think the larger issue here, in answer to your question, is which person, which administration is going out there and trying to solve exactly the problem that newly minted Congressman Suozzi was identifying. This president wakes up every day trying to figure out new ways to help families like the one he grew up in. Most recently, that's been about lowering prices, going after junk fees, actually legislating lower prices for prescription drugs, for health coverage. The opposition wants to take that legislation away. They want to repeal it. Now, if you repeal something that's putting downward pressure on costs, guess what? Those pressures reverse and they go up. So I think it's a very clear matter of who's fighting for whom and who is essentially trying to create a sense of chaos and dysfunction. This president is all about good, solid governance on behalf of working families, and he's got a track record to prove it. And we've got some great unfinished business in the areas of housing, in the area of child care, in the area of lower costs that we'd like to keep working on.
Well, and the ability to continue working on that will obviously depend on the outcome of the election in November. And on that note, Bloomberg, together with Morning Consult, just released a survey yesterday of the swing states, which shows Biden is behind Trump in all 7 of those that we polled. And on the issue of the economy, almost consistently in every state within the data, the feeling of the national economy is much worse than the feeling of the state economy or the local economy. As you get closer to home, people actually feel better. How do you make that resonate nationally? What can the White House do to make the feeling about the economy as a whole better if it's not so bad when you're just looking at your neighborhood?
Well, first of all, let me just say that the poll that matters the most is the one which happens when folks pull the lever or fill in the voting forms, and those polls have consistently favored Democrats. What I would say is that we have to keep our heads down, not get overly absorbed in the ups and downs of the kinds of polls you just mentioned, which have proven to be pretty unreliable, I think, when it comes to actual voting behavior, and focus on very much what we've accomplished and what we intend to continue to accomplish. When we got here, we had an unemployment rate that was unacceptably high, and the very first economic speech that the president gave, he talked about the importance of getting back to full employment. Well, he did that. He got back to full employment very quickly, historically quickly, and we've stayed there. While we've stayed there, we've managed to work on improving the economy's supply side and unsnarl some of those chains, helping to increase labor supply, helping to increase the flow of goods into our retail sector, and that's helped to ease inflation significantly. Meanwhile, he's legislated historic investments in the future in clean energy, in lower health care costs, in domestic production of semiconductors, domestic production of EV cars and batteries. So it's a fantastic track record, and it's one we will continue to talk about. Now, if you want to talk about some indices, I would argue that a good question 3 or 4 months ago is, why isn't everything you're telling me, Jared, reaching the consumer sentiment indexes? But you can't make that argument so strongly anymore. We have the UMich sentiment up even with today's slip. It's up 25% over the past 3 months. So it looks to me like the progress that we're made is actually starting to be felt by more and more consumers. We're going to keep our head down and do all we can to continue to move in that direction.
And Jared, final question for you. You've been very generous with your time today, sir, and we appreciate it. But other news today comes from commercial real estate lender New York Community Bank Corp, plunging again, saying it discovered material weaknesses in how it tracks loan risks. Obviously, there are some idiosyncratic factors at play here specifically for NYCB, but to what extent is the White House concerned more generally about commercial real estate right now, or broader knock-on effects it could have for the banking system?
CRE has been on our watch list at CEA for a long time now, so this is not a new thing at all. What we try to do is get away from any particular case, and especially commenting on any particular case. We don't want to influence market moves at all in this regard.
Sure.
What we're looking at is the impact on the economy, the dynamics, the narrative that you and I have been discussing for the last few minutes out here. And what we see are bank, household, and corporate balance sheets all looking pretty strong. Now, there's been some increases in debt accumulation. There's been some increases in some default rates. But many of those, if you look at them historically, they're kind of coming off the mat. They're back to around where they were pre-pandemic. I think from our perspective, the most important thing is, are those balance sheets as such that we think that the risk of systemic contagion is quite low? And I would argue that they are. If you look at the debt service that folks are paying as a share of their income, it still looks quite low, and that gives us some faith that we're in a good place with the buffers to absorb what we're seeing.